Today I'm going to cover the U.S. debt and the impact that that's having on our economy. And in particular, kind of goes into a little, I want to show you a piece from hedge fund manager John Paulson. He goes a little bit into the political aspect, which I normally don't do, but I'll give a context to it. And then Ed Yardeni, who is a market analyst, and he's been around a long time, and he talks about the effect on the markets depending on which candidate, Harris or Trump, gets elected, kind of what that's likely to do to the markets. And then I think it's kind of unrelated directly to the economy or to the markets, and that is assumable home loans. When you buy a house, you can assume a much lower interest rate home, the mortgage on a home that is at a much lower interest rate. Very interesting, and I'll comment on all that. So I'm Ben Reppond. Today is October 22nd, 2024. Thank you for watching. Welcome to my YouTube channel. And so, as I said, I'm going to begin with this piece by John Paulson. And so he does go into the political aspect. He makes it very clear, at least it was clear to me, that he favors President Trump. And so he makes a case for that, for the benefit of that in the economy. He, is basically partisan in his view, but I'm going to play it. And he talks a lot about deficit spending. And I'll say this about deficit spending. We've seen Democrats and Republicans. I've said this before, they are both big spenders. They have both pretty much equally pushed the debt up. And they have different approaches to it. As I've said before, the Democrats are just big spenders. The Republicans are hypocrites, and they talk a good game, but they get in and they spend. And Trump is no different. He's a big spender. Now, will that stimulate the economy or whatever? I don't know. But he says basically the deficit is a problem. Everybody is starting to talk about it, but isn't it interesting? Here you have people with candidates, Harris and Trump, two very different views of the world and probably different views of the economy. Neither one of them are addressing this issue, which makes me think when they get in, they're both going to be big spenders. This is a problem because we will, in my opinion, our economy, our way of life will eventually collapse if we don't deal with this. We're bringing down spending to the level where we can pay our way. We're bringing in enough money to pay for the money that we're spending. So it's interesting to me that neither candidate is addressing this. So anyway, take a listen to John Paulson being interviewed by Sarah Eisen.
Joining us here at the New York Stock Exchange is Paulson & Company founder John Paulson. Welcome back. Nice to see you.
Hi, Sarah. Great to be here.
So since we spoke a few weeks ago, interestingly, the economy has done really well. We've had plenty of evidence from retail sales to jobs to lower inflation rates that things are going quite smoothly and resiliently for the U.S. economy. Shouldn't that help the incumbents?
Well, it is positive. The tech sector is doing well, but a lot of the growth is due to the deficit spending. This year, the deficit will be a record, estimated at close to $2 trillion. And government spending increased by 14% this year over last year. So the 14% is basically, the increase in government spending is basically accounting for all the GDP growth that we have this year.
In other words, it's not a surprise that the economy is doing well because we're spending so much?
Yeah, it's more deficit spending. Our total debt to deficit to GDP this year will be around 6%, about double what it is in the OECD. So it's an easy way to get growth in the short term, but it has long-term consequences. Plus, the middle class hasn't really benefited. Real wages are still down under the Biden administration. The cost of everything is up, and real real wages haven't grown.
Because I was going to ask about this gap between sentiment and polls, where Trump does get higher marks, and sentiment has been weaker at a time where, we've got near full employment, wages have been rising a little bit, and consumers been spending. It's an interesting kind of divergence.
Yeah, wages have risen recently, but they're still down about 2.5% since Biden entered the administration. So that's why the average American, let's say the bottom half of the country, is having a real difficult time making ends meet. Plus, while the market's up, the manufacturing index is still contracting. I think the ISM was about 47, which shows contraction. So it's not being evenly spread. And that's why all of Trump's economic policies, particularly the tax policies, are to benefit the Americans that need support the most.
Well, I'm glad you brought it up, because you also just said that the deficit spending is a problem. And he has since promised even more tax cuts. I mean, beyond the tips, also on auto loan interest payments, on Americans being taxed abroad. I mean, there's been a long list that have been maybe very popular for voters, but add it all up, and is it a realistic tax policy?
Yeah, I'm not all worried about the deficit under Trump. I think the deficit will come down. The debt to GDP will be stable or come down. His track record has proven that. Under his administration, he brought down taxes. We had higher growth, and inflation was only 1.9%. Inflation under Biden has been 5.7%. So Trump has definitely showed a better ability to manage the economy with more growth, lower inflation, and higher real wages. Regarding his particular tax cuts, he has all the tax cuts are basically focused on the Americans that need it the most. So no tax on tip, help service workers.
Overtime.
No tax on Social Security would help those that need it the most. But all of these things you can put guardrails on them. For instance, Social Security, prior to 1983, they didn't tax Social Security. They started taxing in 83 with a threshold of $25,000 for single filers and $32,000 for married. It hasn't been adjusted since then. So the percentage of Americans, the lowest earning income Americans paying Social Security has increased. So one way to reduce the cumulative impact of tax on Social Security is just by raising the threshold. And it really gives relief in Social Security taxes to the people that need it the most.
So the next piece I want to play is a piece CNBC from Joe Kernan is interviewing Ed Yardeni. Ed Yardeni is a research guy, well-spoken, thoughtful, does a lot of research and sells his research. And his comment is about what is going to happen to the market based on who gets elected, Harris or Trump. And his point is, and I agree with this, by the way, that it may not affect the market. Markets are typically not affected that much. We're focused on the election, but markets are not. Market that you think they should be, but they're not. The market is focused on earnings or price earnings ratio or unemployment or sales or consumer sentiment. It's focused on those kinds of things, not on who is elected or who's in office and so forth. So again, there's a lot of evidence going back a long ways to support this, that geopolitical kinds of things don't affect the market, or if they do, it's very short term and more limited. So he says the markets may or may not be affected by who gets elected. And so it could affect the market, but in my opinion, probably not. He says what's interesting is that the bond market is what is signaling a level of concern. Bond prices are going down, bond yields are going up, / interest rates are going up. And so he says that to him is bond traders are definitely concerned about that. So anyway, take a listen to Ed Yardeni.
Our next guest says the market may be in the early stage of a melt-up. Let's bring in Ed Yardeni, president of Yardeni Research. That certainly isn't, I don't think, consensus, and I guess a lot of people would be surprised by that. Ed, I mean, We've seen it, but every time we see it where we start out a day sort of either quiet or down in the morning or maybe up a little bit, and by the end of the session we're up 200 or 300 points. It's happened again and again and again. That's the characteristics. That's the characteristics of a melt-up, and it's being met with a lot of skepticism. So maybe the ingredients are right.
Well, I think that when you look at the performance of the market, the best way to think about a melt-up is what's the valuation multiple doing relative to earnings? And the valuation multiple has had quite a run. It's up almost 50% since the beginning of this bull market. And earnings have also been improving. So the question is this a PE-led melt-up or an earnings-led melt-up? A PE-led melt-up would be reminiscent of the late 1990s. An earnings-led melt-up would be more sustainable. I think at this point, I'm pleased with what's going on the earnings side. I think earnings are going to be pretty good in the third quarter, but valuation is definitely stretched. It's not as bad as the melt-up in the late 1990s, but it's getting there.
So a melt-up, if we're already in it, maybe we're partially through it, but since the election is in only 15 days, I would imagine that any melt-up would have to span, just go right through the election and then into maybe 2025. Does it matter to you how like so many things, maybe the election is just another one of those data points that may or may not matter much to what the market does as far as the big picture?
Yeah, I hope that's the case, but this is probably going to be a very, very close race and maybe a bitterly contested one. And I don't know that would be a good backdrop for a melt-up. The market might have some second thoughts about that. The other possibility, of course, is a Democratic or a Republican sweep, in which case the market's going to have to be very concerned about deficits being even wider and possible inflationary consequences. And in fact, the stock market's kind of ignoring what's going on in the bond market. Ever since the Fed lowered the Fed funds rate by 50 basis points, guess what? The bond yield's gone up by almost 50 basis points. And so the bond market's signaling that bond investors, my friends, the bond vigilantes, are starting to stir. They're not particularly happy with the potential inflationary consequences of what the Fed did, because the Fed, I think increasingly it's clear, they might have overreacted with the 50 basis point cut and stimulated an economy that doesn't really need stimulating.
So in my research, looking for material that would be relevant, that I agree with and I think would be relevant for you to listen to, I came across this piece, which does not relate to the economy of the market, and it was on home mortgages, assumable home mortgages. Now, for those of you that are old enough, you may go back to the 1970s and remember the period of high interest rates, 70s and early 80s. And so during that period of time, assumable mortgages were common because interest rates got so high, mortgage rates got so high, and there was this period when they were much, much lower. And I remember that. But in the last 40 years, if you go back about 40 years to the early 80s to present, interest rates and mortgage rates have, generally speaking, been coming down. So the idea of buying a home with an existing mortgage and taking over that mortgage at a lower interest rate, I haven't heard that talked about for decades. So anyway, when I saw this, I thought, wow, that's interesting. So I'm going to play this piece for you, and I'll put the link below, and so if you want to listen to the whole thing, you can. Very interesting that apparently there are a lot, not all, but quite a few mortgages. I don't think even the majority, but there are quite a few mortgages that are assumable, and meaning you can take over an existing mortgage at a much lower interest rate. And so that's out there. Now, there are conditions on it. So number one, not all of them are assumable. But you have to find out. I don't know if there's an agenda on the part of the realtor to do this or not do this, but if you search for this, you can find it. And you may need to qualify. Again, I remember back into the 70s that, it may need, you'd have to qualify for the mortgage, which if you're looking at buying a home, you probably would qualify. And you're going to have a higher down payment. So what you're doing is if they bought a home at, let's say, a 2.5% to 3% or even 3.5% interest rate, and today the interest rates are somewhere between 6% and 7%, then what's happened is the value of that home has gone up. So to take over that mortgage, you're going to have to pay the price of the home, including putting a down payment that will cover all of the equity, all the way down to what that mortgage is. So you could be paying, 30, 40, 50% or more of the value of the home just to get that lower interest rate. Not everyone can do that. Some people can, but certainly not everyone. But the benefit is you end up with a mortgage that could be, again, 2.5% to 3%, maybe 3.5%. Maybe some people could get a second mortgage, a home equity loan, and be able to support it that way. But it has a pretty big impact on the payment, and it allows people to get more house for their money. So very interesting piece. So I'll play a piece for you, let you listen to it. Again, it was just new information to me. I hadn't heard this before for a long time. So take a listen to this.
My wife and I have been looking for a new home for the last 2 years.
This is Wes Vandell. He is a new homeowner who is facing many of the same issues other prospective homebuyers have faced in this hot housing market.
We really just hadn't had much luck, mainly due to increasing interest rates driving up the cost of our mortgage. We did put in a couple of offers that didn't go anywhere just because it's a very hot housing market here.
But the Vandell story is a little different than most homebuyers navigating the market right now.
We found one that popped up. So it was the right size, it was the right area, but we knew it was a little bit out of our budget just because the interest rate was too high. Just happened to look at the Realtor app again, and there was a button on that app that said, "This home has an assumable mortgage."
What the Vandells found is a rare type of mortgage called an assumable mortgage, landing them a 2.6% mortgage rate as opposed to the 2024 average, which sits just above 6%.
An assumable mortgage is a type of home loan where the buyer can actually take over the existing mortgage terms from the seller.
That meant a difference of over $800 a month.
A common occurrence in the 1970s and 80s, assumable mortgages are a rare find in today's real estate market. In 2023, only 4,052 Federal Housing Administration mortgages were assumed. That's still a 59% increase in FHA mortgage assumptions since 2021. For Veterans Affairs mortgages, the jump is even larger, with 2,244 mortgage assumptions in 2023, an increase of 713% compared to 2021. And 2024 assumptions are already outpacing previous years for both the VA and FHA. So what are assumable mortgages? How do they work, and why aren't they more common?
The vast majority of homeowners don't actually know that they have an assumable mortgage, buyers don't know how to find them, and agents don't know how to coordinate the purchase.
While assumable mortgages might be a rare find, public interest in them is climbing. Google searches for the term assumable mortgage have climbed in tandem with increasing mortgage rates over the past 2 years.
This is the most unaffordable time to purchase in America of the last 40 years. 60 million people were priced out from being able to purchase a home.
When it comes to the average U.S. home buying experience, most Americans follow the same process. A buyer approaches a lender to get pre-approved for a mortgage. When the buyer settles on a home, they use their own mortgage to cover the cost at a fixed rate. The home buyer then pays off that mortgage over the term of the loan, normally 15 or 30 years. What an assumable mortgage offers is the option to take over the seller's loan. So instead of taking out your own loan at a new rate, you inherit the remainder of the seller's mortgage at whatever rate they took it out at. So a homebuyer that took out an assumable mortgage in 2020 could offer an interested homebuyer a sub 3% mortgage rate.
For the homeowner, the value of including their low rate mortgage in their home sale is to maximize their probability of being able to sell the home by expanding the universe of buyers who can afford to purchase it.
Okay, over 7% for a mortgage, they should call it an uninterested rate. Interesting. Yeah, definitely home prices have gone up and the interest rates have gone up, making the buying of a home out of reach for a lot of people, particularly first-time home buyers. So anyway, I hope you find all that interesting. If you have questions or comments, leave them in the comment section below. Thank you.